Welcome back, everybody, to another deep dive.
Yeah.
We love to really dig into these interesting books on investing and finance. And today, we're going to be looking at A Wealth of Common Sense by Ben Carlson.
Sounds good.
Now, I've been kind of looking through this, and it's not just another how to invest book. It seems like it's,
Yeah, it's very refreshing.
yeah,
Ben Carlson, he brings this really grounded, practical perspective from his background in portfolio management. I think it comes across in his writing for sure.
Yeah.
He's seen it all, basically, and I think that's what makes his emphasis on simplicity so compelling.
Yeah, I think that's one of the things that drew me to this book initially was the title. And just thinking about that, it's like, okay, well, investing of a wealth of common sense, that makes sense.
Yeah.
So it's good to hear that it actually does deliver on that.
Definitely. You can tell he's kind of wary of all that complexity that's out there, and he really gets down to what actually works. He doesn't just throw out like these abstract theories, but he uses real-world examples.
Yeah, I think that's important because we're kind of bombarded with financial information all the time. And it's easy to feel like you need a really complex strategy in order to succeed. But what he's saying is that the key to successful investing isn't about finding some secret formula or chasing the latest trends, but understanding the fundamentals,
Exactly.
sticking to an approach.
Yeah, he really flips the script on the idea that you need some complex secret sauce to be a good investor. He argues that the average person can succeed with a solid understanding of the more conventional, options that are out there.
One of the things that stood out to me right at the beginning was how he talks about risk versus uncertainty. I thought that was a really interesting distinction that he makes.
It's a crucial one for sure. Many people try to predict the market, which is where that uncertainty comes in. But we can't really control uncertainty, can we? It's the
Right.
great unknown.
Right.
But what we can control is risk. And, he talks about things like diversifying your portfolio to manage risk effectively. And that's something we can actually take action on.
Yeah. And I know later on he dives into a lot of market myths too, like the idea that you need to time the market perfectly to make money. But he kind of dismantles that, right?
Oh, yeah, he totally dismantles that. He has some great data in there that shows how difficult that is, even for the pros. And he emphasizes that just staying invested over time can often lead to better
Yeah.
results.
Reminds me of that saying like time in the market beats timing the market.
Exactly. And it's not just about riding out the ups and downs, but having a clearly defined investment philosophy to guide your decisions.
Yeah. So that's really aligning your strategy with your goals, your risk tolerance, and the time you have to invest.
Right. And that's unique for everyone, which is a good thing.
Now, I also appreciated how he gets into like the psychology of investing. He talks about things like loss aversion,
Mm.
which is something that I think we can all relate to.
Oh, absolutely. Loss aversion is a big one. It's that tendency we have to really feel the pain of a loss much more strongly than we feel the joy of a gain. And that can lead to bad choices like selling at the worst possible time.
Yeah, so how do we combat that?
Well, Carlson suggests sticking to your plan. He argues that a disciplined approach can overcome our more emotional impulses. He also encourages people to really understand those behavioral biases that we all have, because once you recognize them, you're less likely to fall prey to them.
So it's like that old saying, know thyself.
Exactly. Self-awareness is super important, and there's a lot of good stuff about that in the book.
There's also been a lot of debate lately about, active versus passive investing. So I'm curious, where does Carlson land on that?
Well, he's got a very balanced view. He kind of lays out the pros and cons of each. Active investing has the allure of beating the market, but it can also be expensive and there's no guarantee that you'll succeed.
So passive investing, like index funds, is the better option.
He does seem to lean a bit toward passive investing, especially for the average investor. He really highlights the power of low fees and broad market exposure. But he also points out that the best approach really depends on your personal situation. So you can't just assume that passive is always better. You have to consider all the factors.
I also noticed that he has a whole chapter dedicated to financial advisors. What's his take on that?
It's a good chapter for sure. He really stresses the importance of finding an advisor who's a fiduciary, meaning they have a legal obligation to put your interests first. He also recommends finding advisors who have really clear fee structures and who can help you build a solid investment plan.
Yeah, I think that's key, having someone on your team who you can trust.
Totally. He also suggests having a written investment policy statement. A document that outlines your goals, your risk tolerance, and your overall strategy.
That sounds really helpful, actually.
It is. It keeps everyone on the same page, you and your advisor, and helps you stay focused on the long term.
Okay, so I think we've got a good overview of some of the main themes from the book, but let's dive deeper into the individual chapters now and see what other nuggets of wisdom we can pull out.
Sounds good.
So how about we start with chapter 3, which is defining market and portfolio risk. This is where he really gets into like the nuts and bolts of risk and how to manage it effectively.
Great place to start. He dispels a lot of common myths about risk in this chapter. It's really foundational.
So what are some of those myths?
Well, one of the big ones is that market volatility is always a bad thing.
But isn't volatility risky by definition?
It can be, yeah. But Carlson says that if you're in it for the long haul, those short-term ups and downs are totally normal and sometimes even present opportunities. It's about shifting your perspective.
So it's like not getting spooked by those temporary drops.
Exactly.
Yeah.
And so how do we as investors manage that risk effectively? Carlson's a big proponent of diversification, spreading your investments across different types of assets so that if one takes a hit, the whole portfolio isn't, decimated.
Right, don't put all your eggs in one basket. That's good advice.
For sure. And he also talks about knowing your risk tolerance, like how much volatility you can actually stomach, and investing accordingly. And he points out that there's no single right way to manage risk. It really depends on you, the investor.
He also brings up some psychological stuff in this chapter, right? Like
Yeah.
how our emotions can impact our investment decisions.
He does, and it's super interesting stuff. We talked about loss aversion before, but he also talks about the cycle of fear and greed that can drive investors to take on way too much risk in good times and then sell everything when the market dips.
So how do we avoid getting caught in those cycles?
Well, he says you need to have a well-defined plan and stick to it, no matter what the market is doing. He also says you need to be patient and play the long game.
It all comes back to discipline, doesn't it?
It really does. He sees discipline as one of the most important keys to successful investing.
Okay, let's move on to chapter 4 then, which is market myths and market history. Now, this sounds like a juicy one.
It is. He really dismantles a lot of commonly held beliefs about how the market works. It's a good read for anyone who's been in the game for a while or is just getting started.
Give me an example, I'm curious.
Well, one of the big ones is that you can time the market, perfectly predicting when to buy and sell to maximize profits.
But don't some people actually make a lot of money doing that?
Some people get lucky for sure, but Carlson argues that consistently doing it is nearly impossible, even for professional investors. He presents research that shows trying to time the market often leads to lower returns than simply staying invested over the long term.
Yeah, I think there's something to that.
He also debunks the myth that you should wait for the market to improve before investing, arguing that waiting could cause you to miss out on those early gains.
And he tackles some other myths too, right?
Yeah, he tackles several actually, like the idea that stocks are always riskier than bonds.
Oh yeah, I've heard that one.
Right, and while stocks are generally more volatile in the short term, historically they've actually performed better than bonds over the long term.
So it's a classic trade-off, risk versus potential reward.
Exactly. And he also debunks the myths that commodities are always a good investment and that housing is always safe.
Those are common beliefs for sure.
Yeah, but he shows how both commodities and housing can be really volatile, and their returns aren't guaranteed. They're not magic solutions.
So I guess his point is that there are no shortcuts.
Right. And he talks about the importance of understanding financial market history, arguing that knowing how markets have behaved in the past can help us make better decisions in the present.
Yeah, I can see that.
If we understand how markets have reacted to past crises, for example, we might be better prepared for future ones.
It's about learning from those past experiences and not repeating the same mistakes over and over.
Exactly. And one of his key takeaways is that this time is rarely different. We always think that the current conditions are unique and that the rules don't apply anymore. But history tells a different story.
That's a good point.
It's easy to get caught up in the hype and think that current trends will last forever. But markets are cyclical. What goes up eventually comes down.
So how can we avoid falling for all these market myths? What's the antidote?
Well, Carlson recommends sticking to evidence-based investing principles, seeking advice from people you trust, and being skeptical. Don't just jump on the bandwagon. Do your research.
That's good advice.
It really is.
Okay, I think we've covered a lot about risk and market myths. So let's shift gears a bit and talk about Chapter 5, Defining Your Investment Philosophy. This seems like a crucial step in the investing journey.
Totally. This is where Carlson gets to the heart of being a successful investor beyond just picking stocks. He starts by really emphasizing the importance of having a clear investment philosophy, your own personal set of beliefs and guiding principles that shape your decisions.
So it's about having like a framework that guides you.
Exactly. And your philosophy should be based on your individual goals, your risk tolerance, and your time frame. It's about understanding what you believe about the market and how that shapes the choices you make. It's very personal.
And he talks about behavioral biases in this chapter as well, right?
Yeah, he dives into those quite a bit. He argues that understanding our biases can really help us avoid making those emotional decisions that can hurt our portfolios. We've got to be aware of them.
And he brings up willpower too, or the lack of it sometimes, right?
Yeah, he says that relying on willpower alone to make good financial decisions is a losing battle because willpower is a limited resource. It gets depleted. That's why having a system in place, a set of rules, is so important. It takes the pressure off our willpower to make good choices even when we're stressed or emotional.
That makes a lot of sense.
He also talks about chasing performance, always jumping into the latest hot stock or fund.
Yeah, that's tempting to do, I've got to admit.
It is, but he says that chasing performance can be really dangerous. Past performance is not a guarantee of future success.
So how do we avoid getting caught up in all the hype then?
Well, Carlson recommends staying focused on your long-term plan, tuning out all the noise and the distractions, and again, seeking advice from trusted sources.
That sounds like a recipe for success to me. Sticking to your guns and not getting swayed by the latest trends.
Exactly.
Okay, I think that's a good stopping point for today. We've covered a lot of ground, from risk and market myths to developing your own investment philosophy.
We have, and I think we've given our listeners a lot to chew on.
And we'll be back in our next episode to continue this deep dive, exploring the rest of A Wealth of Common Sense.
Looking forward to it.
Okay, so let's pick up where we left off. We were talking about building that solid investment philosophy, and now I'm ready to dive into the nitty-gritty of actually putting that philosophy into action.
Sounds good to me.
Chapter 7 is all about asset allocation. So this is where we start to talk about building a portfolio, right?
Exactly. It's where things get real.
Carlson kicks it off by talking about diversification. We hear that word thrown around all the time in investing, but what does it actually mean in practice?
Well, it's really about not putting all your eggs in one basket. You want to spread your investments across different asset classes, stocks, bonds, real estate.
So if one area of the market takes a hit, your whole portfolio doesn't go down with it.
Exactly. Diversification helps you manage risk and make sure no single investment has too much power over your overall returns.
Now, he also talks about this interesting concept called the 80-20 rule in asset allocation. What's that all about?
So this rule suggests that 80% of your portfolio's long-term performance is driven by your asset allocation decisions, and only 20% is influenced by things like stock picking.
Wow, so picking the right mix of assets is way more important than trying to find those individual winning stocks.
You got it. It really highlights how critical it is to get that asset allocation right.
Okay, so how do we do that? How do we figure out the right mix for our own portfolios? Is there some magic formula?
Well, Carlson says there's no one-size-fits-all approach. The ideal asset allocation depends on a few things, like your risk tolerance, your time horizon, how long you have to invest, and your financial goals.
Okay, so a younger investor with more time might be more comfortable with a higher percentage of stocks, while someone closer to retirement might favor a more conservative approach with more bonds.
Exactly, and it's not a set-it-and-forget-it thing either. You'll need to rebalance periodically to make sure your asset allocation stays aligned with your goals as you get older or your circumstances change.
So rebalancing basically means selling off some investments that have done really well and using those profits to buy more of those that have lagged behind.
Yeah, that's the idea. It keeps you from getting too heavily invested in one area and helps you maintain your desired level of risk.
I like it. Now, Carlson also talks about global diversification. Why is that so important?
Well, different economies around the world go through different cycles. So diversifying globally can help smooth out those bumps in the road. It's about spreading your risk across different markets, not putting all your eggs in one geopolitical basket.
I see. So it potentially leads to more stable returns over time.
Right. It's all about managing risk. Now, he also dives into some other interesting concepts like mean reversion and the value premium. These can add some extra layers to your investment strategy.
Okay, break those down for me.
So mean reversion suggests that asset classes tend to return to their historical average returns over time. So if a particular asset class has been doing poorly, it might be poised for a rebound.
So basically buying low in anticipation of a future upswing.
That's the idea. And the value premium is the idea that stocks of undervalued companies tend to outperform stocks of more expensive companies over the long run.
Okay, this is a classic value investing approach, right? Like what Warren Buffett does.
Yeah, exactly. Value investors look for those hidden gems, the companies that the market might be undervaluing.
I like that, finding those diamonds in the rough.
It takes some work, but can pay off. Now, he also touches on alternative assets like private equity and hedge funds. Are those something the average investor should consider?
I'm curious about that too.
Well, Carlson says while they can add diversification to a portfolio, they often come with higher fees and are less liquid, meaning it's harder to get your money out quickly.
So probably not the best fit for someone just starting out.
Yeah, they're typically more suited for institutional investors or people with a very high net worth who can handle the complexity.
Makes sense. Now, what about those smart beta strategies? I keep hearing that term, but I'm not really sure what it means.
Smart beta strategies try to outperform traditional market indexes by tilting toward specific factors like value, size, or momentum.
So they're kind of like index funds with a little extra boost.
Yeah, you could say that. They try to capture specific market inefficiencies that normal index funds might miss.
Interesting. It's like there are always new things popping up in the investing world.
Right. There's always something new to learn and explore. It's a dynamic field.
Okay, so we've covered asset allocation pretty thoroughly, from diversification to those alternative assets. But what about the human side of investing? You know, the people who can help us navigate all of this. That's where Chapter 9 comes in, financial professionals.
Yeah, this chapter is all about the role of advisors and when you might need one.
So does everyone need a financial advisor?
Carlson says, not necessarily. If you have the time, the knowledge, and the temperament to manage your own investments, you might be fine going it alone.
But for many people, having that expert guidance can be really valuable.
Absolutely. Especially if you're new to investing or you're feeling overwhelmed, or maybe you just don't have the time to really stay on top of things. An advisor can be a great resource.
Okay, so how do you go about finding a good advisor? There are so many out there. It's hard to know where to start.
Well, Carlson emphasizes finding an advisor who's a fiduciary, meaning they're legally required to put your interests first. And he recommends looking for advisors with transparent fees and a clear investment philosophy that matches your own.
So it's about finding someone who's on your team who you can trust.
Exactly. He even provides some helpful questions to ask potential advisors, like their experience, their qualifications, their approach to investing, and how they handle conflicts of interest.
So it's all about doing your homework.
It really is. And he also warns about some red flags to look out for, things like unrealistic promises, pressure to buy specific products, or being shady about their fees.
So if it sounds too good to be true, it probably is.
Exactly. Trust your instincts. If something feels off, walk away.
Now, he also talks about the importance of education in the advisor-client relationship.
Yes, he says a good advisor will educate you about the fundamentals of investing. They'll help you understand your own risk tolerance and guide you through those market ups and downs. It's a partnership.
So it's a two-way street. It's not just blindly following their every word.
Right. And he says being a good client means being honest about your financial situation, communicating your goals clearly, and being open to their advice.
It's a relationship just like any other. It takes work from both sides.
Exactly. And he emphasizes having that written investment policy statement, the document that outlines your goals, your risk tolerance, and your strategy. It serves as a roadmap and keeps everyone on the same page.
So no surprises down the road.
Exactly. And he also provides some tips for making sure your advisor is truly acting in your best interest.
That's important. You're trusting them with your financial future.
It is. He says to make sure you understand their fiduciary duty, review their recommendations carefully, and even seek a second opinion if something doesn't feel right.
So you're not just handing over control and hoping for the best.
Exactly. You have to stay involved.
Now, what about those alternatives to hiring a traditional financial advisor? What about those robo-advisors or fee-only planners?
Those can be great options, especially for people who are comfortable managing their investments online, or maybe who want a more hands-off approach or just lower fees.
So there are options for everyone, no matter their needs or their budget.
Yeah, there really are. And finally, he talks about the value of emotional coaching from a financial advisor.
I think that's an overlooked aspect, but it's really important.
It is. A good advisor can provide support and guidance during tough times, when the market's going crazy.
So they can help you stay calm and rational when things are feeling chaotic.
Exactly. They can be a voice of reason when you need it most.
Okay, so we're back for the final part of our deep dive into a wealth of common sense. We've been through a lot with Ben Carlson already and learned so much.
It's been great. I'm ready to see how he wraps it all up.
Me too.
Hmm.
Let's jump into Chapter 8, Saving and Spending Habits. Now, this one feels like a little bit of a shift from the investing chapters.
It is, a little bit, but it's super important because Carlson argues that our saving and spending habits are just as crucial to building wealth as our actual investments. They go hand in hand.
It's about building that solid foundation.
Exactly. You can't invest what you don't save, right?
Right.
And he actually challenges that traditional retirement planning idea, working for 40 years and then just stopping completely.
Yeah, that model feels kind of outdated these days.
Totally. He encourages people to think about their finances and their careers more holistically, like over their entire lifespan.
So it's not just about accumulating enough to stop working. It's about designing a life you enjoy and don't need to retire from.
Yeah, finding something that's fulfilling and provides you with financial security. And he also talks about lifestyle creep, which I think is something we've all probably experienced at some point.
Yeah, tell me about that.
It's that tendency to increase our spending as our income grows. It's easy to fall into. We get a raise and suddenly we need a bigger house or a fancier car.
You got to keep yourself in check.
Exactly. Got to stay mindful. He also recommends tracking your spending and making a budget.
That sounds like budgeting 101.
It is, but so many people don't do it. It's amazing.
Ignorance is bliss until it's not.
You said it. If you don't know where your money's going, how can you make good decisions about it?
He also provides some practical tips for actually saving money, like automating your savings, negotiating those bills down.
All great tips. And he doesn't just talk about the numbers either. He gets into the psychology of spending, too.
I like that he weaves in the psychology throughout the book. It makes it more relatable.
Definitely. He talks about how a lot of our spending decisions are driven by emotions. Trying to keep up with others, the fear of missing out.
It's so true. You see everyone on social media going on fancy trips and eating at fancy restaurants.
Exactly. And it makes us want to do the same, even if it doesn't align with our budget or our goals.
So we have to be aware of those emotions.
Exactly. Be conscious about your spending. Now let's move on to Chapter 10, Behavioral Finance. I feel like we've been talking about behavioral biases a lot already, but he really goes deep in this chapter.
What else does he cover?
Well, he talks about things like confirmation bias, anchoring bias, the endowment effect.
Refresh my memory. What are those again?
Confirmation bias is that tendency to only look for information that confirms what we already believe. And we ignore anything that contradicts that belief.
I think we're all guilty of that sometimes.
Absolutely. It can be a problem with investing because it might make us hold on to a losing investment for way too long, just hoping things will turn around.
Yeah. Or we might buy a stock because everyone's talking about it, but we haven't really done our research. What about anchoring bias?
So anchoring bias is when we fixate on the first piece of information we get, even if it's not relevant or accurate.
So maybe we see a stock price at a certain level and then assume that's a good deal, even if the company's fundamentals have changed.
Yeah, that's a good example. And then the endowment effect is all about overvaluing things we already own. Like, it's harder to sell something we own because we think it's worth more than it really is.
Yeah, I can see how that could affect investment decisions.
It makes it hard to let go.
So how do we overcome all these biases then? It sounds like we're kind of wired to make bad decisions sometimes.
Carlson emphasizes self-awareness as that first step. You have to recognize your own biases and notice how they're affecting your thinking.
It's about challenging our own assumptions.
Exactly.
Yeah.
Don't be afraid to question yourself and be open to new information.
Now, in Chapter 11, he talks about 10 things I believe about investing. So this is like his personal investment creed.
Exactly. He shares the 10 key principles that have guided his own journey and offers them as a framework for other investors to consider.
What are some of those?
Well, he believes that keeping things simple is better than getting too complex. He also says patience is more important than trying to be brilliant, and that your behavior is the most important factor of all.
I like that. It's about managing your emotions, not the market.
He also talks about diversification, staying the course, not trying to time the market, all those fundamental things we've been discussing.
It's nice to see them all laid out so clearly.
It is, and he makes sure to remind people that there's no single right way to invest. The best approach is whatever aligns with your goals, your risk tolerance, and your time horizon.
So it's about finding what works for you as an individual.
Exactly. There's no magic formula.
Okay, last chapter. Chapter 12 is called We Have No Idea What the Future Holds. I love that title,
It's so true.
especially in the world of investing.
Investing is all about dealing with uncertainty, and Carlson encourages people to embrace that uncertainty. Don't be afraid of it.
But that's easier said than done.
It is, but he says that if we can accept that we don't know everything, we'll be better equipped to make good decisions.
So it's about being flexible and adaptable.
Yeah, and focusing on the things we can control, like our savings rate, our investment costs, our own behavior. Those are the things we have power over.
So don't try to control the uncontrollable.
Right. And he reminds us that investing is a long game. Those short-term ups and downs are just part of the journey.
So don't freak out when the market has a bad day or week or even month.
Exactly. It's all about the long term.
Well, this has been a really fascinating deep dive. What are your final thoughts on A Wealth of Common Sense?
I think it's a must-read for anyone who wants to be a successful investor. Carlson's approach is practical and insightful. He doesn't shy away from the complex stuff, but he explains it in a way that makes sense.
I agree. He cuts through the noise and gets to the heart of what really matters. Simplicity, discipline, and patience.
Those are the key ingredients. He really drives home that building wealth isn't about getting rich quick. It's a slow and steady process.
It's about making smart choices, staying focused, and not letting your emotions get the best of you.
You got it. What about you? What are some of the key takeaways you'll be carrying with you?
Well, I really appreciate his emphasis on having a clear investment philosophy and understanding your own biases. I also think his advice on finding a good advisor is invaluable.
Those are great points.
So to wrap up, what's one piece of advice you would give to someone who's just starting out on their investing journey?
I would say keep it simple, stay disciplined, and be patient. Investing doesn't have to be complicated. Focus on the fundamentals, make smart choices, and you'll be on the path to success. It's all about taking it one step at a time.
Excellent advice. Thanks for joining me on this deep dive. It's been a pleasure exploring a wealth of common sense with you.
The pleasure was all mine. Happy investing, everyone.
And remember, common sense is often the most valuable asset of all.